Hello, and thank you for listening in to our second quarterly market update. My name is Stuart Dodwell, and I'm the Executive Manager of Finance and Insolvency in New South Wales. Together with my colleagues in the Restructuring Services Division of Pickles, we will be bringing short market videos to you, our special clients, each quarter. Through popular demand and off the back of our inaugural market update for the first quarter, presented by our fearless leader Ben Gibbo Gibson, we will share tangible insights and trends that will help our valued clients get a deeper understanding of the current market. We are in a privileged position to bring our clients the rawest of market intelligence and deep data analytics harvested directly from our $3 billion in annual gross sales across key market segments in industrial, automotive and salvage. Pickles value in excess of $10 billion in assets per year with our largest in-industry valuation team, which provides us with the best market knowledge we can share. I trust you will find this information useful for you and your colleagues, and as always, please don't hesitate to contact our team for further information regarding this short market update. Let's kick it off with industrial. Our overall industrial market continues to see a lack of supply across some sectors, which contrasts with the severe lack of supply across all sectors we saw for a continued period throughout 2021 and 2022. This lack of supply is influenced by an asset-by-asset factor and no longer an entire industrial market issue. The macro factors that continue to impact markets is ongoing labour shortages affecting business owners who struggle to find operators. This, coupled with inconsistent or consistent regulation changes, has driven some long-standing business owners to divest and sell their businesses and assets, which has seen several large asset sale packages come onto the market in the past 6 months. Further macro influences to the market has been multiple interest rate rises, along with cost of living pressures and the end to the instant asset write-off tax incentive schemes, which has impacted demand for secondary equipment. What we are noticing come hammer time in our auctions? Well, there is no more panic buying. Hit and miss sporadic demand and elevated results have exited the auctions. Clearance rates are down. Vendors continue to have inflated expectations on their assets. Stock levels are down, however, is not having the impact it did because the demand is not marrying up. There is a trend in oversupply of older equipment. Higher hour kilometres and age assets are hitting the secondary market as operators held onto these assets longer while supply was down. These assets had to hit the market at some stage, and we are starting to see that now. The right assets in a strongly promoted sale continues to do well, like where there's a story, insolvency, liquidation, or retirement of business. Maintenance and fleet reputation are more important than ever when selling in these secondary markets. A good reminder for operators and lenders to focus on asset maintenance and ongoing servicing. Let's dive into some of the asset pools in the Australian transport market today. Prime movers and line haul trailers. These guys have been the shining star, consistently achieving high secondary prices and demand for nearly 2 years running. The market is receding, particularly for assets more than 5 years old. The peak season for prime movers and line haul trailers is when the big man in the red suit is getting ready to arrive. With retail spending tightening and less boxes or presents being transported, this peak season it is forecast to be soft. There is a shortened supply in European prime movers from 18 months down to 6 months. Kenworth trucks continue to have long lead times, seeing strong secondary market demand. Larger Tier 1 operators achieving stronger buying power than the smaller customers. Agricultural equipment in grain handling, tippers and livestock trailers is softening. Japanese trucks. Very sporadic auction results in these segments is the current trend. Auctioneers and staff are finding it very challenging to meet expectations, needing to work harder and longer on buys just to clear the stock. The market in this asset class has largely normalised. There are still some wait times, however the market has adapted to this. Specialised assets, asset classes like fuel, heavy haulage, late model tipper trucks and dog trailers, consistently in strong demand, however a volatile asset market. Anything with a custom-made body requirement, there can be up to 2-year wait times. Earth moving and construction. We are not seeing the OEM and supply chain issues we saw throughout 21-22. These conditions have improved. OEM finance options increasing, driving sale of new stock. Higher hour equipment is falling dramatically, particularly in the over 7,000 hour asset class. The excavator market is oversaturated with little to no demand for over 13 tonne excavators. Low hour equipment, sub 2,000 hours, that's still very strong. Demand for cranes has held strong off the back of several mid-size operators exiting the market and still a continued lack of supply. Agriculture. Supply for equipment is returning to more normal levels. Falling commodity prices are squeezing operators' cash flows and forecasts. There is a genuine fear of a dry period, and that is tempering demand. No rain, no cash. Cotton and grain markets are holding okay for now. Increased inquiry level over the past 8 weeks re the sale of agri assets nationwide suggests consolidation and a need for cash. There is still a demand for good equipment, but a gap between market and expectations written down values is seeing sellers hold off. Victoria into southern New South Wales is expecting a strong harvest, meaning cash buyers will potentially support other segments of the country where they are looking to sell excess equipment. Dealers are being aggressive on trying to move equipment to reduce their floor plan exposures. In summary, the honeymoon is over, but we are just returning to more normal market conditions. The market conditions previously seen throughout COVID and exiting COVID were rather abnormal conditions which were never going to last. Check out some of these sale results, differentials, as an illustration to what I've just been discussing. This brings a little bit of it to life. So a Kenworth K200 line haul road transport truck, 2017 K200 big cab selling in February 2023 for $225,000. 2018, a year younger, same truck, selling in October 2023 for $155,000. That's a 32% reduction. Drop deck tautliners, line haul trailer used for road transport. A 2017 Vaudrey drop deck, selling in November 22 for $95,000. Or 2017, same drop deck trailer, now selling in October 23 for $76,000. That's a 20% drop. Mitsubishi Fuso Canter, refrigerated truck for metro and coal delivery. 2017 Canter 515, selling in January 23 for $25,000 to $30,000. In 2018 model, a year younger 515 same Canter, selling in September 23 for $17,000. That's a 32 to 44% drop. 20 tonne hydraulic excavator, commonly used in the civil construction space. 2011 Hitachi ZX200, it's sold in February 23 for $77,000. 2 year younger machine, same make and model, sold in October 23 for $51,000. That's a 34% difference in just 8 months for a younger machine. Motor vehicles update. We are extremely fortunate to be sharing with our clients the most current data of any secondary market in the used car space. Pickles sell over 52,000 vehicles and over 150,000 salvage vehicles each year. Our data analytics business, Datium Insights, includes a team of data experts that can provide the best trends and insights for our clients. So what's been happening out there in automotive land? Well, after 2 years of near continued used car price growth, the last 18 months have seen prices soften. New car sales and stock levels have increased, combined with broader economic pressures, softening demand for used cars. Car producing nations have steadily increased production volumes the past 6 months. Production levels are still below pre-COVID levels, and recently Eagers suggested there is a 300,000 vehicle black hole to fill in Australia. While supply has risen in late 2023, it is unlikely we will reach pre-COVID levels until late 2024. New car sales. New car sales peaked in 2017. In 2023, sales are on track to exceed 2017 numbers, where a high percentage of the 2023 sales being a result of a backlog of new car orders. Feedback from our dealer networks suggests new car orders and inquiry levels are low at present. New car sales mix remains consistent with circa 55% sold to private buyers and 45% to business. Current used car supply. At Pickles, we have seen a month-on-month increase since April 2023. Fleet and government segments are experiencing the greatest increases of vehicles to sell, whilst councils and SMEs are also increasing our throughput as a result of new car orders. Dealers and OEMs are distributing higher portions of new cars to these segments, and this is expected to continue well into 2024. With this greater supply, it is likely to expect a continued easing of used vehicle prices. Used car prices. Can you believe that used car prices increased up to 50% during the period March 2020 to March 2022? It had to be expected that at some point that climb to the summit would need to turn around and descend. From March 2022, the climb declined, with used car prices now being 25% higher than pre-COVID summits. New car supply has steadily increased, resulting in 5 months of consecutive record new car sales. In contrast, consumer demand is softening as a result of broader economic pressures both here in Australia and overseas. Interestingly, prices have descended rapidly throughout September 23rd quarter. Where are prices heading? They are still far from the bottom. Pickles projects used vehicle prices will not return to pre-COVID values. We estimate the market will continue to decline until late 2024, with prices remaining circa 10 to 15% higher than pre-COVID levels. The main forces for the ongoing pressures on used prices include increased delivery levels of new cars, the backlog of orders slowly being fulfilled, economic pressures, interest rates will continue to bite, continued price increases in new car RRPs. Valuation trends. Our valuation team has seen a softening in asset finance valuation pipeline post June 30, 2023. The feedback is deal flow is harder to find. Small scale, single asset finance reduced as a result of the end to instant asset write-off incentives. Insolvency evaluation appointments has seen a significant increase, particularly in the mid-market SME size business. Insolvency trends. Both corporate and personal insolvency appointments are increasing, with total number of appointments up from 835 in April to 1,175 appointments in August, but reducing back to 978 in September, off the back of better economic conditions and a resurgence in retail spending. The 4-month-long upward trend in corporate insolvency appointments came to an end in September as better economic and trading conditions have helped keep businesses out of insolvency. These numbers are still below the long-term averages. SME space most heavily impacted. Pickles insolvency sale volumes are the highest in 3 years, indicating a lift in distressed sales. Pickles mercantile team have seen significant growth in inbound files, indicating personal bankruptcy and insolvencies are rising. We have noticed a trend in equipment being disclaimed by appointees post receiving our valuations, meaning the equipment does not contain equity and these assets are being handed back to the bank or financier. This is a significant shift from 12 months ago, when asset prices were elevated and the appointees had equity. There will be a reasonable expectation for a return on the asset after sale. With this in mind, it is extremely important to obtain up-to-date valuations, as the values are not the same as they were 12 months ago. Between a more active ATO and an RBA that is committed to slowing the economy, corporate insolvencies are predicted to rise through 2024. Pickles Asset Management Services, PAMS, team is a specialised mercantile team that assists financial clients with recoveries and asset management services. Q1 of 24 saw 927 instructions received, which is down 15% on the prior quarter, but up 44% on Q1 23. With forecasted interest rate rises to come and household spending to decrease, this will have an impact on repossessions, seeing the number of engagements increase into 2024. In summary, The sky is not falling, and this is not doom and gloom in what may feel like a drastically changing market. However, we do not buy into that negativity. We have witnessed abnormal markets that are unsustainable long term. The market is normalising and prices are following suit. We hope you have found this useful. Please feel free to share it around your teams and your colleagues and clients, and don't hesitate to reach out to Pickles advisory team if you would like to understand more of our Q2 market update. Thanks for watching.